Hello everybody, welcome to Sir Chua's Accounting Lessons PH, and today we will be discussing the last part of the conceptual framework for financial reporting. Let's start. So in our previous videos, we have already discussed the scope and purpose of the conceptual framework. We have also discussed the first 4 chapters, and we are to discuss the last 4 chapters, Chapter 5, Recognition and Derecognition, Chapter 6, Measurement, Chapter 7, Presentation and Disclosure, and Chapter 8, Concepts of Capital and Capital Maintenance. Okay? Let's start with Chapter 5, Recognition and Derecognition. So when we say recognition process, recognition is the process of capturing for inclusion in the statement of financial position or the statements of financial performance an item that meets the definition of one of the elements of the financial statements, which is an asset, liability, equity, income, or expenses. It means that from the things that we have discussed in the previous videos, as you remember, nilagay natin doon na there is a criteria when to say na it is an asset, a liability, or an equity, income, or expense. Now, capturing those information for including them in the statement of financial position and the statement of financial performance is the process that we call as recognition. You are recognizing them so that you can include them in your financial reports. Recognition involves depicting the item in one of those statements that we have mentioned earlier, either alone or in aggregation with other items, in words and by a monetary amount, and putting monetary amount itself is the thing that we will be discussing later about measurement, and including that amount in one or more totals in that statement. Now, the amount at which an asset, liability, or equity is recognized in the statement of financial position is referred to as the carrying amount. So let's say, for example, if you look at the statement of financial position with the line item property, plant, and equipment, and you see a number there, you see an amount there, that amount is called the carrying amount of that asset, or in case of a liability or equity in the balance sheet, those are their carrying amount when it is the amount that is recognized in the statement of financial position. Recognition links the elements, the statement of financial position and the statement of financial performance. And paano po nangyayari yung linking na yon? First is, in the statement of financial position at the beginning and end of the reporting period, total assets minus total liabilities, as you know, it equals equity, and recognize changes in equity during the reporting period. Those changes in equity, which is actually seen in the statement of changes in equity, include income minus expenses recognized in the statements of financial performance and any contributions from holders of equity claims minus distributions to holders of equity claims, which are equity transactions that you can see in the statement of changes in equity. So to make it more clear for all of you guys, the conceptual framework for financial reporting has actually provided us this diagram. So the statement of financial position at the beginning of the reporting period, so let's say, for example, we're talking about financial year or fiscal year or calendar year, whatever, 2022, for example, and December 31, 2021, which is equal to January 1, 2022 in terms of beginning balances. As you know, the ending balance of the previous period will be brought as the beginning balance of the next period. Okay, so the statement of financial position at the beginning of the period, and then there will be an effect of these changes in equity, which is income minus expenses, which is represented in your statement of financial performance or in your income statement, and any contribution from holders of equity claims minus distributions to holders of equity claims. Now, those changes in equity will have an effect on the beginning balance of your statement of financial position, which will lead to the ending balance to be presented in December 31, 2022, and still asset minus liabilities equal equity. Okay? So basically, all of these changes in equity in terms of your financial performance and other transactions relating to equity are actually the things that affects the beginning balance of your statement of financial position balances, which leads you to the ending balance of your statement of financial position. Now, recognition criteria. Only items that meet the definition of an asset, liability, or equity are recognized in the statement of financial position. If they don't qualify with those criteria that we have discussed in the previous videos, then it's not recognized in the statement of financial position in the same way that the only items that meet the definition of income and expenses will be recognized in the statement of financial performance. Derecognition is basically the opposite of recognition, which is the removal of all or part of a recognized asset or liability from an entity statement of financial position. So when you recognize, you put them in the statement. When you derecognize, you remove them from the statement. Derecognition normally occurs when the item no longer meets the definition of the asset or liability. And when it no longer meets the definition of an asset or a liability, you have to remove it in the statement of financial position. So for an asset, derecognition normally occurs when the entity loses control or part of the recognized asset. As you know, control is part of the criteria on how do we recognize these assets, right? And then for a liability, derecognition normally occurs when the entity no longer has an obligation for that certain liability. You're no longer obliged to do these things or the obligation of this liability, then you derecognize that liability in the statement of financial position. Okay, let's move on with Chapter 6 of the framework, which pertains to measurement. Ito po yung kasunod na step after mag-recognize. So after you recognize, you have to put an amount on the statements in that certain line item, and that is measurement. So the first thing is about historical cost measurement. So historical cost measures provide monetary information about assets, liabilities, and related income and expenses using information from the price of the transaction or other event that gave rise to them. In short, you measure the asset, liability, income, or expense on how much was it at that time of the transaction. In short, the price of the transaction. Unlike current value, historical cost does not reflect any changes in value. Kung ano yung time ng transaction at kung magkano siya nung time na yon, to be very mababaw, no? Kung magkano siya nung time na yon, that's how you put historical cost. Okay? Except to the extent that those changes relate to the impairment of an asset or liability becoming onerous. Later on, when you get to intermediate accounting subjects, you have to adjust those historical costs. Let's say, for example, PPE, and then you have to test them for impairment, and then you also deduct your accumulated depreciation, as you know, in your basic accounting in senior high school. So the items that we report in the statement of financial position are actually still affected by some of the things that you have to deduct. But when we say historical cost, it's the price at the time of the transaction, to be very subtle about it. Okay, so historical cost of an asset when it is acquired or created is the value of the cost incurred in acquiring, or in case the asset is created, basically creating the asset, comprising the consideration paid, how much did you pay to acquire that asset, plus any relevant transaction cost. And each of our standards will tell you ano po yung mga related transaction costs for that certain asset. The historical cost of a liability when it is incurred or taken on is the value of the consideration received to incur or take on the liability minus the transaction cost. In short, the transaction price at that certain time of the event of the transaction. Okay? Now, when we say current value measures provide monetary information about assets, liabilities, and related income and expenses using information updated to reflect conditions at the measurement date. Because of the updating, in short, kapag ka sinabi natin current value, merong naga-update na amount, okay? Current values of assets and liabilities reflect changes since the previous measurement date in estimates of cash flows or other factors that is reflected in those current values. So unlike historical cost, the current value of an asset or liability is not derived from the price of the transaction or other event that gave rise to the asset of liability. And what are the kinds of these current values? So we have fair value, value in use, and fulfillment value, and then the current cost. So let's talk about them one by one. When we say fair value is the price that would be derived to sell an asset or paid to transfer a liability in an orderly transaction between market participants at the measurement date. How much is it measured in case it is a transaction between market participants outside. Okay? Fair value reflects the perspective of market participants. Participants in a market to which the entity has access. The asset or liability is measured using the same assumptions that market participants would be using when pricing that certain asset or liability if those market participants act in their economic best interest. There's actually a separate IFRS for fair value measurement, if I'm not mistaken, IFRS 13. Okay? And then, what do we say about value in use and fulfillment value? When we say value in use, it is the present value of cash flows or other economic benefits that an entity expects to derive from the use of an asset and from its ultimate disposal. Now, in value in use, we are actually respecting the present value of cash flows or other economic benefits that the entity expects to derive from the use of the asset. Now, value in use is used basically in assets. But when we say fulfillment value, that is that pertains to the fulfillment of a liability. So the fulfillment value is the present value of cash or other economic resources that an entity expects to be obliged to transfer to fulfill a certain amount of liability. Those amounts of cash or other economic resources include not only the amounts to be transferred to the liability counterparty, sino po ba yung mismong company or person na basically kanino ka magfulfill nung liability na yon, but also the amounts that the entity expects to be obliged to transfer to other parties to enable it to fully fulfill that liability. That's what we call fulfillment value. Now, another current cost is, meron pa pala dito. Sorry. Okay. So, because value in use and fulfillment value are based on future cash flows, they do not include transaction costs incurred on acquiring an asset or taking a liability. However, value in use and fulfillment value include the present value of any transaction cost an entity expects to incur on the ultimate disposal of the asset or fulfilling the liability. Now, when we say current cost, the current cost of an asset is the cost of the equivalent asset at the measurement date, comprising the consideration that would be paid at the measurement date plus the transaction cost that is incurred at that certain date. Meanwhile, when we say current cost of a liability is the consideration that would be received for an equivalent liability at the measurement date minus the transaction cost that would be incurred at that date. Now, when we say current cost, like historical cost, it is an entry value. Kung magkano siya nung time na yon, yun na yon. It reflects prices in the market which the entity would acquire the asset or incur the liability. So, it's different from fair value as what we discussed earlier, as well as value in use and fulfillment value, because these three, fair value, value in use, fulfillment value, all of them are called exit values. However, unlike historical cost, current cost reflects conditions at that certain measurement date, like historical cost. Okay, so those are measurement principles that you have to know, and we proceed with Chapter 7, Presentation and Disclosure. Presentation and disclosure are actually communication tools. You present, you disclose, so you communicate. A reporting entity communicates information about its assets, liabilities, equity, income, and expenses by presenting and disclosing information in the financial statements. When you present, when you disclose, you communicate. That's it, okay? To facilitate effective communication of information in financial statements, when developing presentation and disclosure requirements and standards, a balance is needed between, number one, giving entities the flexibility to provide relevant information that faithfully represents the entity's assets, liabilities, equity, income, and expenses. And you should balance it basically with information that is comparable from period to period for a reporting entity in a single reporting period and in a single reporting period across entities. So kung babalikan po natin yung concept ng comparability from period to period within the same company, intra-company comparability or intra-comparability, and single reporting period across entities, you compare them across entities, inter-company comparability or intercomparability. Okay, yun po yung dapat binabalanse natin against the flexibility to provide relevant information na sinasagot po natin yung tinatawag nating faithful representation of the elements of the financial statements. Okay? To facilitate effective communication, which is part of your responsibility in terms of presentation and disclosure. Now, when we say classification, you classify. And when we say classifying in the accounting process, it is the sorting of assets, liabilities, equity, income, or expenses based on their shared characteristics for presentation and disclosure purposes to make it more understandable. Such characteristics include but not limited to the nature of the item, its role, function within the business activities conducted by the entity, and how it's being measured. Classification is applied to the unit of account selected for an asset or liability. However, it may sometimes be appropriate to separate an asset or liability into components that have different characteristics and to classify those components separately. That would be appropriate when classifying those components separately would enhance the usefulness of the resulting financial information. For example, it would be appropriate to separate an asset or liability into current and non-current classification and to classify those components separately. In terms of you want to enhance the usefulness of the information and you want to make it understandable. That's why we classify certain amounts of assets and liabilities, no? To answer and enhance the value of the information that we report. Okay, now, regarding the classification and regarding these presentation, we have what we call as offsetting, no? We have a concept of offsetting. Offsetting occurs when the entity recognizes and measures both an asset and liabilities as separate units of account but groups them into a single net amount. So, asset minus liability yung presentation depende sa relationship ng transaction. Offsetting classifies dissimilar items together and therefore is generally not appropriate. So, let's say for example, talagang dissimilar yung items tapos gusto mong i-offset as to a certain net amount lang na total asset number minus total liability number and then ipapresent mo siya as a net amount. It's generally not appropriate because you didn't know the details between the two. Pinag-minus mo agad so you don't know the asset details, you don't know the liability details. So, it's not actually good for you to do that. Okay? Hindi na tayo understandable. To provide useful information, it may be necessary to classify equity claims separately if those equity claims have different characteristics. Similarly, to provide useful information, it may be necessary to classify components of equity separately if some of those components are subject to particular legal, regulatory, or other requirements. For example, in some jurisdictions or territories, an entity is permitted to make distributions to holders of equity claims only if the entity has sufficient reserves specified as distributable. Separate presentation or disclosure of those reserves may provide useful information, and these are our concepts or rules that we have to follow in case we have to classify equity transactions. For income and expenses as to profit or loss and other comprehensive income and expenses are classified and included either in the statement of profit or loss or the traditional income statement that you know, or outside the statement of profit or loss as OCI. We will be discussing that further when we will be talking about the statement of comprehensive income. The statement of profit or loss is the primary source of information about an entity's financial performance for the reporting period. That statement contains a total for the profit and loss that provides a highly summarized depiction, and as we have told you last time, when we say profit or loss, it represents the entity's financial performance for that period. Many users of financial statements incorporate the total in their analysis either as a starting point for that analysis or the main indicator for the entity's financial performance for the period. So yung iba, starting point lang siya ng analysis. Yung iba naman siya na yung mismong indicator ng financial performance, depende sa trip ng users of financial statements kung paano gagamitin yung information na yon, either as a starting point or a main indicator of financial performance. Now, we also have what we call the concept of aggregation. Aggregation is you add together similar assets, liabilities, equity, income, or expenses. Shared yung characteristics nila, kaya pagsasama-samahin mo na sila. Aggregation makes it look clean. because you summarize a large volume of detail. However, you have to properly balance it on how much aggregation you have to do when they have shared characteristics, because aggregation conceals some of that detail. A balance needs to be found so that relevant information is not obscured either by large amount of insignificant detail or by excessive aggregation. Kasi kapag masyado naman hindi ka nag-aggregate, masyadong marami yung details na nakalagay na sobrang similar lang naman din ng characteristics, you have to aggregate it. Pero kapag ka super aggregated ka naman, there might be important information that you might miss when you aggregate too much. That's why you don't present things in full detail. You aggregate them when they have shared characteristics, but make sure that you balance it na you will not obscure or you will not be able to hide a very significant detail naman that will be helpful in understanding and basically making decisions when the users read the financial statements. So different levels of aggregation may be needed in different parts of the financial statements depending on the nature. So for example, the statement of financial position and financial performance provide summarized information and more detailed information provided in the notes. So let's say for example, property, plant, and equipment as one line item in the statement. But you can go to the notes to the financial statements to properly see the detail. Ano po ba yung laman mismo ng property, plant, and equipment? Ganon siya. Okay? And then let's go to the last part, which is concepts of capital and capital maintenance. Okay. So we have actually two concepts, which is the financial concept of capital and physical concept of capital. So the financial concept is the one that we use most of the time. It is adopted by most entities in preparing their financial statements because under this concept, such as invested money or invested purchasing power, capital is the one that you know, which is the net assets or equity under a financial concept of capital. But when we say a physical concept of capital, it is actually the entity's operating capability. Capital is regarded as the productive capacity of an entity. For example, how many units of output can they do per day? Okay? Now, the selection of an appropriate concept of capital should be based on the needs of the users of financial statements, although what we use most of the time is the financial concept. A financial concept should be adopted if the users are primarily concerned with the maintenance of nominal invested capital or the purchasing power, basically the more numeric or quantitative side of capital. If, however, the main concern is the operating capability of the entity, then you use the physical concept of capital. The concept chosen indicates the goal to be attained in determining profit, even though there may be some measurement difficulties in making this concept operational. That's why we always use most of the time the financial concept of capital. Okay, so under the financial capital maintenance concept, there is profit if the financial amount of net assets at the end of the period exceeds the financial amount of net assets at the beginning of the period. Pag mas malaki daw yung ending balance ng equity mo versus a beginning balance ng equity, ibig sabihin lumaki daw. So, dahil lumaki, from beginning going to end, nagka-profit ka. Okay? Financial capital maintenance can be measured in either nominal monetary units or units of constant purchasing power. Now, when we say physical capital maintenance, profit is earned if the physical productive capacity of an entity, or basically the resources or funds needed to achieve that capacity at the end of the period, exceeds the physical productive capacity at the beginning of the period, after excluding any distributions and contributions to owners for the period. So, the physical capital maintenance concept looks more on the physical productive capacity or operating capability of an entity. Pero check mo rin kung mas mataas siya at the end of the period versus the beginning of the period. So pag tumaas, may profit ka din. Parang ganon. Okay? Now, revaluation or restatement of assets and liabilities gives rise to increases or decreases in equity. While these increases or decreases meet the definition of income and expenses, they are not included in the income statement under certain concepts of capital maintenance. So where should we put them? We include them as capital maintenance adjustments or also what we call as revaluation reserves. And that is the end of our discussion for the conceptual framework for financial reporting. And then for the chapters that we have discussed in this video, let's have a short quiz. Ganun po uli, 1 to 5. Question number 1. The process of capturing for inclusion in the statement of financial position or the income statement, an item that meets the definition or one of the elements of financial statements. If you need more time, pause the video, then play it again when you're ready. The correct answer for this, terminology lang to, so it will be easy for you. This is recognition. Let's proceed with question number 2. Which of the following statements is correct relative to the different measurement bases in accounting? So if you go back to the different measurement bases, nabanggit lahat to dito, but what statement is the correct one? So pause the video and play it again when you're ready. The correct answer is letter B. So yan lang po yung correct. Fair value is the price that would be received to sell an asset or paid to transfer a liability in an orderly transaction between market participants at the measurement date. Okay, what made letter A, C, and D wrong? The historical cost of an asset is when it is acquired or created is the value of the cost incurred in acquiring or creating the asset, which comprises the present value of potential future cash flows. You don't check the present value under historical cost concept. Value in use is the future value of the cash flows or other economic benefits that an entity expects to derive from the sale of the specific asset. So mali po yan kasi dapat present value. And then current cost of an asset is the cost of an equivalent asset at the measurement date, comprising the consideration that would be paid at the measurement date, excluding transaction cost that would be incurred that date, dapat including. So sa letter D, isang word lang yung binago natin, na mali na agad siya. Number 3, Statement 1. Effective communication of information and financial statements enhances the understandability and comparability of information and financial statements. Statement 2. Classification is the sorting of assets, liabilities, equity, income, or expenses on the basis of shared characteristics for presentation and disclosure purposes. A, B, C, and D. Pause the video if you need more time and play it again when you're ready. The correct answer is letter C. Both statements are actually correct, so we don't have to explain more about them. That's actually the concepts that we have discussed earlier. Question number 4. Which of the following statements pertain to the financial capital maintenance concept? So, all of these here are actually pertaining to the physical capital maintenance concept. Only one of them pertains to the financial capital maintenance concept. The correct answer is letter B. Capital is synonymous with the net assets or equity of the entity. And last question, question number 5. Which of the following statements is incorrect? So A, B, C, and D. Pause the video and play it again when you're ready. The correct answer is letter C. So that is the incorrect statement and the correct answer is letter C. Aggregation makes information more useful by summarizing a large volume of detail, and it is still helpful even if the aggregation conceals some important details. No, you actually have to balance your aggregation because ang iniiwasan natin is you might conceal some important detail if you aggregate too much. Okay? Then A, B, and D are all correct statements. And that's the end of our discussion for the conceptual framework for financial reporting. And our next lesson is IAS 1, presentation of financial statements. Okay, again, please like, share, and subscribe to Sir Chua's Accounting Lessons PH and hit the notification bell button and comment down your questions, suggestions, and reactions for this video. This has been Sir Chua's Accounting Lessons PH. To God be all the glory, honor, and praise. See you in the next video, and thank you very much.